You've been told the US dollar is the unshakable foundation of the global economy. That gold is a relic, a barbarous artifact from a bygone era, and that Bitcoin is just a speculative bubble for digital gamblers. That's the official story you hear on repeat from financial news anchors and talking heads. But while they're telling you to look one way, the world's most powerful financial institutions are quietly looking the other. In the hushed corridors of central banks, a monumental shift is underway. They're making a very different bet. They are triggering a modern day gold rush on a scale we haven't seen in our lifetimes, and they are quietly preparing for a world that depends less and less on the dollar. The question is, what do they know that you don't? For 80 years, the world has run on a simple premise: the US dollar is king. Born from the ashes of World War II at the Bretton Woods Conference in 1944, the dollar was crowned the world's reserve currency. At first, it was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar. This system created stability. The dollar was quite literally as good as gold. But in 1971, that promise was broken. Facing rising domestic spending and the immense costs of the Vietnam War, President Richard Nixon severed the dollar's final link to gold. In what became known as the Nixon shock, the world was pushed into a new era of purely fiat currencies, money backed by nothing more than government promises and public trust. To keep the dollar dominant without gold, a new informal arrangement was forged: the petrodollar system. Through a series of understandings, the United States offered military security to major oil producing nations, like Saudi Arabia. In return, these nations agreed to price most of their oil in US dollars and invest a large portion of their oil profits back into US government debt, known as treasuries. This masterstroke created a constant, artificial demand for dollars. Any country that needed to buy oil, which was basically every country, had to get their hands on dollars first. This cemented the dollar's role as the indispensable currency for global trade. For decades, this system worked. It gave the United States what one French finance minister called an exorbitant privilege. The US could print money to finance its deficits, buy goods from all over the world, and essentially export its inflation to other nations. The world's central banks had little choice but to hold massive reserves of US dollars and treasuries to do business and stabilize their own economies. But today, those foundations are cracking. That exorbitant privilege has become an exorbitant burden. The United States national debt has spiraled into the tens of trillions, a number so vast it's hard to even comprehend. To fund its spending, the US Treasury has to issue a relentless stream of new bonds, and the Federal Reserve has to resort to monetary policies that, over time, devalue the very currency the world depends on. This isn't a conspiracy theory, it's happening in plain sight, and the rest of the world has been watching, taking notes, and getting more and more nervous. For years, they played the game because there was no other option. But the world is changing. The unipolar moment has passed, and a multipolar world is emerging. In this new world, depending on one single country is seen as a dangerous vulnerability. Nations are starting to see the dollar not just as a global utility, but as a tool of American foreign policy. They see a currency whose supply and payment systems are controlled by one nation and whose stability depends entirely on political decisions made in Washington, D.C. They're starting to ask a dangerous question. What happens when America's interests don't line up with ours? What happens when the anchor itself starts to wobble? This wasn't just a theoretical fear. In February 2022, it became brutally real. When conflict erupted in Eastern Europe, the United States and its allies unleashed a financial weapon of unprecedented power. They froze nearly half of Russia's $640 billion in foreign currency reserves. In an instant, hundreds of billions of dollars, euros, and pounds held by the Russian central bank in overseas accounts were made inaccessible. It was a financial shock and awe campaign meant to cripple a G20 economy. While asset freezes against smaller nations like Iran or Venezuela had happened before, this was different. This was Russia, a major world power. Suddenly, it was cut off from its own savings. The message sent to the rest of the world was chillingly clear: your US dollar reserves are not truly yours. They exist at the pleasure of the US government. They aren't a risk free asset. They're a privilege that can be revoked at any moment. This one act was the catalyst. It turned quiet concerns about dollar dominance into urgent policy changes in capitals from Beijing to Brasilia. For finance ministers and central bank governors, the freezing of Russia's reserves was a wake up call. They realized their country's economic sovereignty was fundamentally compromised by their reliance on a dollar based system. Their national savings, built up over decades, could be wiped out with the stroke of a pen in a foreign capital. The weaponization of finance was no longer a theoretical risk, it was a demonstrated reality. This didn't trigger a total abandonment of the dollar, but it aggressively accelerated the search for an alternative. It forced every nation to reevaluate what a true safe asset is. What is money you truly own? An asset that can't be frozen, seized, or devalued by a foreign power? The answer they landed on wasn't new. It was the oldest one in the book. They turned back to gold. What followed wasn't a public panic. It was a quiet, methodical, and relentless accumulation of physical gold by the world's central banks on a scale not seen in over half a century. This wasn't just a few countries hedging their bets. This was a structural shift in the global monetary system, happening just below the surface. The numbers are staggering. In 2022, central banks collectively added a colossal 1,082 tons of gold to their reserves, according to the World Gold Council. This shattered a 55-year record. To put that in perspective, it's more gold than the entire official reserve of a major economy like India. It was a declaration of intent written in solid gold. And the buying spree didn't stop. In 2023, they did it again, purchasing another 1,037 tons. For 2 consecutive years, central banks bought gold at a pace that was more than double the average of the previous decade. They were taking somewhere between a quarter and a third of all new gold mined globally and locking it away in their vaults. So, who were these buyers? While many central banks operate with secrecy, the data shows a clear pattern. The People's Bank of China became the world's biggest reported buyer, steadily building a strategic reserve shielded from the dollar system. But they were far from alone. Turkey, facing high inflation and geopolitical pressure, was a huge buyer. Poland made headlines by bringing its gold home from London and aggressively adding more, with its central bank governor openly stating the goal was to bolster financial security. Singapore, a bastion of stability, made an uncharacteristically large purchase. India, the Czech Republic, Qatar, the list of buyers spanned continents and political loyalties. This is not the behavior of institutions that think the current system is stable. It's the action of institutions diversifying their assets for a more uncertain world. The secrecy is just as telling. A significant portion of the buying is attributed to unreported purchases, meaning some central banks are accumulating gold off the record, unwilling to broadcast their drift away from the dollar to the world, and specifically to Washington. This rush to gold is a flight to safety and a flight to sovereignty. Unlike US treasuries, which are digital entries on a ledger, physical gold held in your own country's vault has no counterparty risk. It can't be frozen by a foreign government. It can't be devalued by another country's printing press. It is the ultimate neutral reserve asset. A 2025 survey of central banks highlighted this shift in thinking. The survey, which had the highest ever participation, found that a record number of respondents believe global gold reserves will increase over the next year. While the original script's 95% figure was an overstatement based on early reports, other surveys from 2024 showed that over 80% of central banks expected holdings to rise. This isn't a fringe movement, it's a powerful consensus among the world's financial gatekeepers. They are diversifying their holdings, moving towards an asset that has outlasted every empire and every currency in history. Gold's share of disclosed global reserves has risen, and while the dollar still dominates, the trend is undeniable. This isn't just rebalancing a portfolio, it's a quiet challenge to the dollar-centric order. To really get what's happening, we need to look back in time, long before the dollar, to the origins of money itself. The story of money is a story of evolution, a search for a reliable store of value. And one of the biggest chapters in that story was the great transition from silver to gold. For thousands of years, silver was the dominant monetary metal. From the Roman denarius to the Spanish pieces of 8, silver was the money of the people and of trade. It was more abundant than gold, perfect for everyday transactions. Gold existed, of course, but it was mostly the money of kings and emperors. The two metals coexisted in a delicate bimetallic balance. But in the 19th century, that ancient system started to unravel. The Industrial Revolution was transforming the world, trade was exploding, and the need for a single stable monetary standard became critical. Silver started to show its weakness. The problem was supply. Massive silver discoveries, like the Comstock lode in the US, flooded the market. As the supply of silver shot up, its value fell against gold. The world's great economic powers saw the writing on the wall. Great Britain, the global empire of the era, had been on a de facto gold standard since the time of Sir Isaac Newton. Its currency, the pound sterling, was stable because it was anchored to a scarce asset, gold. One by one, other nations followed. Germany adopted the gold standard in 1871. After long and bitter political fights, the United States officially adopted it in 1900. It was a domino effect. To trade with a gold standard nation, it was best to be on the gold standard yourself. The transition was about trust. Gold was scarcer, more durable, and its supply grew at a slow, predictable rate of just 1 to 2% a year. This inherent stability, this hardness, made it the ideal anchor. Nations were choosing certainty over uncertainty, scarcity over abundance. They were abandoning a weaker money for a stronger one. This historical playbook is reenacting right now. But today, the asset being hedged against isn't silver, it's the US dollar. And the asset being embraced as the ultimate safe haven is, once again, gold. The reasons are eerily similar. The dollar, like silver back then, is suffering from a supply problem. Its supply isn't growing from new discoveries, but by the keystrokes of a central bank creating trillions of units out of thin air. This debasement, driven by unsustainable debt, is eroding trust in the dollar's long term value. Central banks today are making the same calculation their 19th century predecessors did. They are diversifying away from an asset whose value can be diluted and towards an asset that is finite, neutral, and has held its value through every crisis in human history. They are relearning a lesson that was forgotten for a couple of generations. True wealth isn't held in someone else's liability, but in a tangible asset that you control. But the story doesn't end there. Because in the 21st century, a new character has entered the stage, a digital asset that mirrors gold's ancient appeal in a new technological form. As central banks pivot back to the ancient safety of gold, a parallel, more radical story is unfolding. A new asset born just over a decade ago is quietly being considered as part of this new financial architecture. That asset is Bitcoin. On the surface, gold and Bitcoin couldn't be more different. One is a dense yellow metal physically held in guarded vaults. The other is a string of code on a global, decentralized ledger. Yet if you look past their physical form at their core properties, they are remarkably similar. They are two sides of the same coin, the search for hard money. Think about what makes gold a great monetary asset. It's scarce, it's durable, it's divisible and portable, even if it's a bit clunky. And crucially, it is sovereign. It's not the liability of any government. Now consider Bitcoin. It is provably scarce. There will only ever be 21 million. It's incredibly durable. As long as the internet exists, the Bitcoin network does too. It's supremely divisible and portable. You can move $1 billion worth across the globe in minutes. And most importantly, like gold, it's sovereign. In fact, it reaches a level of sovereignty that's hard to match. While a government can seize a gold bar, seizing Bitcoin from someone who has properly secured their private keys is incredibly difficult. It's a bearer asset in its purest form, decentralized with no central authority that can change the rules, freeze transactions, or inflate the supply. For years, Bitcoin was dismissed by the mainstream as rat poison squared, a fad. But the same forces driving central banks to gold are forcing them to take a second look at Bitcoin. The weaponization of the dollar, spiraling debt, and eroding trust have highlighted the need for assets that exist outside the traditional system. Gold is the established answer. Bitcoin is the emerging, high-tech parallel. It's a hedge against the same risks, designed for a digital world. The first movers here aren't the big, established powers. They are the smaller, more nimble nations. And the country at the forefront of this daring experiment is a small Central American nation that much of the world had written off, El Salvador. In September 2021, El Salvador did the unthinkable. It officially adopted Bitcoin as legal tender, becoming the first nation in the world to do so. The move was met with ridicule and condemnation. The IMF and World Bank warned of dire consequences. To them, it was reckless. But from the perspective of El Salvador's president, Nayib Bukele, it was a calculated gamble. El Salvador has a unique set of problems. It doesn't have its own currency. It dollarized its economy in 2001, outsourcing its monetary policy to the US Federal Reserve. It has no control over its money. Furthermore, a large portion of its population is unbanked, with some estimates as high as 70%. They have no access to basic financial services. The economy also depends heavily on remittances, money sent home by Salvadorans working abroad. These remittances account for nearly a quarter of the country's GDP. But legacy services like Western Union can take a huge cut with fees of 10% or more. For El Salvador, Bitcoin wasn't a speculation. It was a potential solution. First, it was a step toward de-dollarization, a way to regain some monetary sovereignty. By holding a non-sovereign hard asset like Bitcoin, El Salvador was diversifying its treasury. Second, it was a tool for financial inclusion. With just a cheap smartphone, any Salvadoran could access a global monetary network. It was a way to bank the unbanked. Third, it aimed to slash the cost of remittances. Using Bitcoin's Lightning Network, Salvadorans could send money across borders almost instantly. While the real world costs aren't zero once you factor in spreads and converting back to dollars, it has the potential to be significantly cheaper than traditional channels. El Salvador began buying Bitcoin for its national treasury, with President Buchel famously announcing he was buying the dip. It's important to note these holdings are not transparently audited, but the public strategy is clear. The country launched a government wallet, invested in volcano-powered Bitcoin mining, and focused on education. The experiment is still young and has had challenges. Widespread adoption has been slower than hoped, and the international financial institutions remain skeptical. But to dismiss it is to miss the larger point. El Salvador's gambit is a live test of a new monetary theory, a modern echo of the historic shift from silver to gold. A small nation feeling the instability of the dominant system is taking a bold step to adopt a harder, more sovereign form of money. They've created a template, and they're not the only ones watching. While El Salvador's move is public, this digital asset is also weaving its way into the strategic calculations of the world's major powers. The geopolitical great game is going digital, and Bitcoin is an unexpected piece on the board. Consider China. On the surface, Beijing is hostile to decentralized crypto. It has banned trading and mining to maintain strict capital controls. But that's only half the story. While cracking down on private crypto, China is pioneering its own central bank digital currency, the digital yuan, a tool for ultimate state control. At the same time, the People's Bank of China has been the world's most aggressive buyer of physical gold. This dual strategy is telling. Accumulate a neutral physical asset to de-risk from the dollar while building a digital currency you completely control. While there's no public evidence of state-level Bitcoin holdings, many analysts find it hard to believe a nation so strategic isn't studying it as a potential non-state asset that exists outside the control of its main rival, the US. Then there is the United States itself. Officially, the US stance has been confusing. But behind the scenes, a different reality is taking shape. The US is one of the largest holders of Bitcoin in the world, not through purchase, but through seizure from criminal enterprises like the Silk Road. For years, the policy was just to auction these assets off. But that thinking may be evolving. Since 2025, whispers have surfaced in financial circles about a potential shift in US strategy, the idea of creating a strategic Bitcoin reserve. While this remains purely speculative and unconfirmed, the very discussion is a seismic shift. It suggests some at the highest levels view Bitcoin not as contraband to be dumped, but as a strategic asset to be held. Other nations are making their own moves. Ukraine embraced crypto to receive hundreds of millions in donations during its conflict. Investigative reports have revealed that the nation of Bhutan is mining Bitcoin with its hydroelectric power, turning stranded energy into a digital asset for its sovereign wealth fund. Even in Argentina, a country with a painful history of currency crises, there have been shifting signals about allowing banks to offer crypto services, a tacit acknowledgement that citizens are desperate for an escape from the collapsing peso. Each of these examples paints a picture of a world grappling with the end of a monetary era. They are all, in their own ways, preparing for a future where value is not solely defined by the full faith and credit of the United States. They're building lifeboats, some made of gold, some made of code. We stand at a historic inflection point. The global financial system built on the US dollar is transforming. For decades, the world accepted the dollar's exorbitant privilege as the price of stability. Today, that stability is fracturing and the privilege is looking more like a liability. The weaponization of finance, shown by the freezing of Russia's reserves, was a wake up call for every nation that their economic sovereignty was conditional. This has ignited a quiet but determined search for financial independence. The most powerful expression of this is the modern day gold rush. Central banks are diversifying their promises of fiat currency with the timeless certainty of physical gold. Their record breaking purchases are a tectonic shift, a vote of no confidence in a debt fueled dollar centric world. And as this ancient playbook is revived, a new chapter is being written. Bitcoin, a digital echo of gold's scarcity and sovereignty, has emerged as a surprising new player. For nations like El Salvador, it offers a path to financial independence. For global powers, it represents a new strategic asset in the great game of geopolitics. The transition from silver to gold in the 19th century wasn't an overnight event. The shift we're living through won't be either. It will be complex and at times chaotic, but the direction of travel is clear. The world is moving away from a system based on one nation's debt and toward one based on neutral, sovereign assets. The official story may not acknowledge this. The talking heads may keep praising the dollar's dominance, but the actions of the world's most informed financial institutions tell a different story. They're not listening to the words, they're watching the debt clock. They're not trusting promises, they're trusting math and physics. They are preparing for a post dollar world, 1 ounce of gold and one line of code at a time. The real question is, are you? If you want to understand the hidden forces shaping your financial future, make sure you subscribe and hit the notification bell. The biggest stories are often the ones happening just beneath the surface. And for those that have made it this far, I have a special gift for you. In the description below, there is a link to take Module 1 of my Macro Investing Masterclass absolutely free. You can have all 5 lessons at no cost to you, and we won't even ask for a credit card. Just a thanks for watching until the end.